If you look at the data from the last century of geopolitical conflicts, you find a recurring statistical anomaly. Common sense says that the outbreak of war should crash the market, but history shows the exact opposite. The crash almost always happens before the first shot is fired, and the moment the war actually begins, the market rallies. This is what researchers call the war puzzle. Today, we are breaking down the Swiss Finance Institute's findings. We'll look at the Sadameter, Knightian uncertainty, and why the most dangerous thing in the market isn't a missile, it's the unknown. In a 2012 study, the Swiss Finance Institute analyzed the lead-up to the 2003 Iraq War. They tracked the probability of conflict against global equity prices. They called this probability index the Sadameter. The correlation was undeniable. As the probability of war rose from 20% to 90%, the market fell consistently. Oil prices spiked, the fear premium, equities bled out. This is the pre-war phase. It is characterized by a slow, grinding sell-off. But why? If the war hasn't started, why is the capital fleeing? To understand this, we have to look at a concept introduced by economist Frank Knight in 1921, Knightian uncertainty. Risk is a game of poker. You don't know the outcome, but you know the mathematical odds. Algorithms can price risk. Ambiguity is playing poker with half the deck missing and the rules changing every hand. In the pre-war phase, the market is trapped in ambiguity. Because institutions cannot calculate a risk premium, they exit the market entirely. They sell stocks, they sell bonds, and they move to cash. They're not just avoiding loss, they're avoiding the unknown. This leads to the part that confuses most retail investors. During this panic, you often see safe haven assets like gold and silver take a hit too. Take March 2020 or the lead up to 2003. Gold doesn't always go up during the initial panic. It's a liquidity crisis. When institutions face margin calls on their equity positions, they have to raise cash immediately. They sell what they can sell. They sell their liquid winners, often gold and silver futures, to pay for their losing stock positions. This is why paper price drops. Physical demand might be skyrocketing, but the paper markets reflect the desperate need for liquidity. This is the ultimate trap for the unprepared. So, when does it end? The data is clear. The bottom usually forms the moment the invasion is confirmed. When the war starts, ambiguity collapses into certainty. It might be grim certainty, but it is calculable. The market can price a war. It can model defense spending, supply chain disruptions, and inflation. The capital flows back in. The takeaway is simple. The market doesn't panic because of the tragedy. It panics because of the question mark. Once the question mark is gone, the crash is over. I'm Julian Weber. Join us as we architect the next era.